Now to move on to the compromise and planning for a tax debt compromise. It is important to note here that there are various aspects or facets to a successful compromise. The compromise, unlike the deferral, involves a far greater understanding, firstly, of the necessary requirements and the background, the history of the liability that has given rise to this. Whereas the deferral, it's very much a listen, I've got X, split it into 6X or 12X, and I'll settle that over the respective time period. With regards to the compromise very much hinges on financial uncertainty and financial difficulty. If a taxpayer is in a precarious financial position, then they may be eligible for a compromise of tax debt. However, it must be noted that the documentary burden for a compromise is quite substantial. And as much as this is contained in Section 200 of the Tax Administration Act, what we've seen through practice is, yes, there is a document list there that goes from A to H, which is all good and well. It's a signed motivation letter from the taxpayer providing a full background and their proposed settlement amount. It is also then the completed collection information statement, which is the taxpayer's declaration of the truth and accuracy of the data provided to SARS, along with a lot of spreadsheets. So in the case of an individual, almost everything is on a spreadsheet, save the motivation letter and the CIS form. And in the case of a company, this does include their annual financial statements or their management accounts, or as the case may be. But there are also certain nuances, very dependent on the particular taxpayer's circumstances, that do require further engagement with SARS. And off the back of that engagement, in most cases, they do request further documentary evidence that is not noted in Section 200 of the TAA, but SARS does need the information in order to have this properly considered by the committee. All right. Now, the effect of a tax debt compromise is, if we take a liability of 100,000, and from an affordability perspective, the best the taxpayer can do is 50,000. The balance of the 50,000 is thereafter written off by SARS by means of a reverse journal entry. Very similar to the deferral, there is a signed agreement in place between the taxpayer and SARS, which is a Section 200 compromise agreement, whereby it states the amount written off, as well as the number of installments, if it's a hybridization between a compromise and a deferral, as well as the settlement amount and the number of days the taxpayer is given to make payment of the settlement amount as per their application. Bearing in mind that the documentary burden is heavy, and I say this because part of the documentary burden, both for individuals and corporates, is a 3-year projection of income and expenditure. And this can be quite labor intensive, to just put it mildly. And this is something that SARS very much requires, because in terms of considering these applications and before it goes forth to the committee, what must be noted is SARS looks at a tick box approach, and all boxes must be ticked. There's about 9 of them, and it all pertains to various documentation. Now, in terms of the actual planning for a tax debt compromise, as mentioned earlier, this is very much dependent on financial hardship and financial circumstances of the taxpayer and surrounding the liability. But at the same time, it is dependent on their assets versus their liabilities and their cash on hand. In the rare instances, we do actually see SARS requesting from a taxpayer, in the event that you were to take out a loan what would be the highest possible loan you could secure, and when can you secure this? Would you be able to secure it, and can you use it to settle its liability? However, that's in a very rare case where the taxpayer's financial situation and their financial hardship is not sufficiently evident to the committee when considering the matter. What we have seen with the tax debt compromises is a settlement of a tax debt compromise can be anything from one I had in February this year, where we settled for 10% of the liability and wrote off interest and penalties in entirety, um, to something more along the lines of 50% or 60% of the liability. But that being said, that's very much the capital liability. In terms of actually getting it through, it's very much region dependent, and the PCC or contact us at SARS addresses are the addresses which must be used during the submission process. So those are correctly allocated amongst the regions themselves, dependent on where the taxpayer is registered.